You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everybody, that music means it's time once again for the Advisor's Option, the program here on the Options Insider Radio Network, where we break down all of the amazing option strategies and techniques, and as well as some of the breaking news in the world of options that you, the busy financial advisor, may have a hard time keeping track of. You're busy managing your clients' accounts, after all, or maybe you're not aware of them, or maybe you want to learn more about how these options products work and how you can incorporate them into your clients' portfolios. Well, don't worry. We've got you covered here on the Advisor's Option. My name is Mark Longo from the Advisor's Option, as well as, of course, from the Options Insider Radio Network, where we have quite a few programs, including many, many archived episodes of this fine program, the Advisor's Option. Where can you find all of that? Well, of course, the easiest place, the mothership, the flagship, theoptionsinsider.com. While you're there, of course, click on the Insider Radio Network tab, or just even easier, there's a call out right there on the homepage on the right-hand side. So pick the show you want, click on it, and you're off to the races. You can always find us, of course, via iTunes, TuneIn, and Stitcher as well. 15 total programs for you guys to sink your teeth into. The easiest place to get them all, of course, to subscribe to the main network feed in your iTunes or your platform of choice, and you'll get it all delivered to you instantaneously, day in, day out. It's a lot of content, so hopefully you're ready for it, including quite a few episodes of the Advisor's Option. Of course, you can always grab us via our mobile app as well, available in all the major app stores. And while you're listening, make sure you hit us up with your questions, your comments. We love to hear from you guys. We got a great panel assembled for you today to break down some post-election volatility as well as some other topics. So let's introduce them. Let's go in order of reverse proximity today. So we're going to go far out. I'm not sure which. I think you're both out in Puerto Rico, so I guess we'll start with Randy. He is Randy Swan, the co-founder of Swan Global Investments. Randy, welcome back to the Advisor's Option program. And where are you joining us from? Is it Puerto Rico, or are you out in Colorado, or perhaps parts unknown?
Actually, I'm in Puerto Rico. I just got back from New York earlier this week, where the weather was terrible and rainy, and it's good to be down in the Caribbean at this time of year.
So you do get the reverse proximity award. You were also, I guess it's a tie between you and Chris Hausman, of course, the chief technical strategist over there at Swan Global Investments, also joining us from warm and sunny Puerto Rico. Chris, welcome back to the Advisors Option Program. To you as well.
Hey, Mark, thanks for having me again.
Somehow you made the cut yet again, Chris. Amazing. How that works.
All right.
A couple episodes in a row now. It's becoming a record for you. And, of course, an old friend of the network. He's been on this program a few times. It's been a little while. He is good old Mike Tusaw from RCM Wealth Advisors, joining us from a lot closer to home, from scenic and sunny St. Charles, Illinois. Mr. Mike, welcome back to the Advisors Option Program, sir. It has been too long.
It has. It's always a pleasure to be here talking the advisor side of the business.
Yeah, we get to do that a lot on the option block, so it's good to kind of delve into this side for a nice change of pace. And rounding out our panel today, we have a newcomer to the program and indeed to the network. He is Jim Keeling, joining us from MoneyBlock. Jim, welcome to the Advisors Option Program.
Hi, Mark. How you doing? I'm happy to be here. I don't know what I'm doing in cold Kansas City when I live in sunny Southern California, but happy to learn and listen along, and if I can contribute, that's great.
So you live in Southern California, but you're in Kansas City. Yeah, that's you chose the wrong end of the stick, I think. I think there.
Mom's birthday.
Oh, well, there you go. You got to do what you got to do. And Jim, since this is your first time on the program, why don't you go ahead and give our listeners a little bit of an overview of your background, in the options and derivatives world, as well as what it is you do over there at MoneyBlock.
Okay. Just briefly, I do have a law degree, and I am a CPA. I've been trading options for more than 30 years. My first experience with them was trading the old OEX options. These days, my preferred strategies are diagonal spreads and put credit spreads for long simulation positions. And I like doing a lot of the risk-free projection strategies with the SPY using the weekly options when I can. Don't always get a chance to put them on, but when they're there, it's a nice high probability type of trade.
All right, and with the gang assembled, let's dive right on into our Options 101 segment.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, welcome to Options 101. We're taking a little bit of a different tack with the segment. This episode is not your traditional what's a call, what's a put, what's a vertical, that sort of thing, but we have a unique opportunity in our hands here to explore, maybe learn a little bit. So we thought we'd take it. Of course, a lot has happened in the marketplace since the last time we all gathered together here on the old Advisors Option Program. Namely, we had a big presidential election here in the U.S., and so we've seen a lot of developments on the volatility front as a result. So we thought this was a great time. Take a little bit of a post-mortem. On our last episode, we kind of talked about the run-up to elections and kind of how that typically impacts volatility. Now we have an interesting kind of frame of reference to look back on that whole period, including the post-election period, which was quite wild, and break it down a little bit for you guys. So we're going to do just that here at the top of the show. So let's start off, like I said, on the last episode, we kind of talked about, and Chris actually detailed an interesting paper he wrote up where kind of breaking down a lot of how these elections typically have played out, how much they've impacted volatility through metrics like the VIX and others in the past. Of course, there are a number of issues with that, not the least of which being that we don't have a huge data set for these. Obviously, elections are every 4 years here in the U.S., and the VIX itself only has data sets going back about 20-odd years. So we have a limited number of elections to actually analyze. But that said, there was some interesting nuggets. If you want to hear all that, I encourage you, again, to check out our previous episode. But, of course, then we have the election itself. And leading into the event, it seemed like the outcome, given all of the polling, we won't get into the issues with polling, that's a different show, but it seems like given the polling, it seemed like one outcome was being priced in by the market. And then, of course, as we all know, that night, everything went topsy-turvy in terms of the predictions, the analytics, and, of course, the marketplace. And if you were watching the marketplace last night, and I'm sure a lot of our advisors and asset managers listening were doing just that, it was a tumultuous period, to say the least. We had the S&P future selling off about 100 or so handles, maybe a little little more. The Dow futures off about 1,000 or so. The VIX futures spiking up into I think around the 23 range, maybe 24, coming off after being in the mid-teens earlier. So just a frenzy on every level. And then, of course, the next morning and the subsequent weeks, once we kind of had a grasp on who the actual winner was, and there wasn't going to be recounts and other things, and all of a sudden the market, having that certainty behind it, just kind of went off to the races. We've had a protracted rally ever since in the underlying indices, and a commensurate sell-off in volatility. So there's a lot of different regimes have been unfolding, kind of the ramp up into the election, the aggressive spike, and then aggressive kind of return to somewhat normalcy in that night of the election. And then, of course, the subsequent slow sell-off we've seen in volatility as a result. So three kind of different and distinguished kind of regimes just in the past few weeks here from volatility. So a lot to sink our teeth into. And it certainly has a lot of impact on all things options. So let's start off. Maybe Randy, we'll start with you. You haven't been on in a little while. It's been just a tumultuous period for the market. Obviously, it's probably been a tumultuous period for your clients. What has this last few weeks, the last month or so, really been like for you? How has it been impacting how you guys are implementing the DRS? And just a lot of other thoughts on how this just erratic period of volatility has been playing out for you.
Well, as a firm, as you know, the futures sold off very heavily during the night when the income or the election was in doubt. We didn't obviously do anything during that time period, so I think it was almost a non-event from a trading perspective as it relates to Swan. Now that the market seems to be off to the races, finishing and closing on the last month of the year, we're talking re-hedging portfolios and when's the optimal time to do that. Obviously, any year that you have an up year, we'd like to try to protect those profits by re-hedging at a higher level, and that's kind of what the process that Chris and I were actually, in fact, talking about today.
Well, Chris, since Randy mentioned to you, you're obviously out there implementing a lot of this stuff as well over there. Walk us through your thoughts on that. What was that tumultuous period like? Obviously, you guys are you're not really in the future side, so that probably, as Randy said, worked out pretty well in your favor overnight because you were kind of somewhat insulated from a lot of that move. But walk us through kind of your thoughts, the impact on that, what you're hearing from some of the clients, as well as the impact for you going out there and trying to actually, obviously you're going out trying to buy protection. So volatility levels having a lot of issues on that. You're also selling other options to pay for that protection. So you have skin on that side of the fence as well. Walk us through how that's been impacting you maybe from an implementation perspective as well.
Yeah, just to reiterate, it was a kind of a non-event for us. We've been prepared for these events. We've gone through Brexit. We've gone through August 24th, and this was, with our 19-year track record, we're prepped for this kind of thing. So all that research that we talked about on the last show, knowing that volatility was going to increase prior to the elections, we played into that, and we played into that really well. So the overnight session we were able to handle because we were able to take advantage of these elevated volatility levels prior to the election. And as a result, even the large move that we had in November, we were pretty, we were positioned quite well. Needless to say, like you said, we are taking advantage of selling income. And sometimes if you have these big moves, it can be challenging. But, if you can time your volatility right, especially when some type of big event is on the horizon, such as the elections, it can be beneficial for our portfolio as a whole. So I do want to put some closure on a stat. I don't know if you remember last time I was on the show, there was a stat that if the S&P 500 is down between July 31st and October 31st, that the opposing party wins 86% of the time. So I know I was saying that stat last time and I kind of wasn't believing it, but now I got to believe it. And next time we have an election, I'm going to turn to this stat again.
There you go. That was one of the few accurate prognosticators in a season where pretty much everything seemed like it was completely thrown out as terms of any sort of efficacy from a predictive capability. But you're right, Chris. It was kind of a period where you guys obviously have the hedging. You also have the income side. So on the income side, you kind of had to be a little bit patient, and that seems like that's one of the takeaways from this tumultuous period is that the patient volatility traders, particularly on the short side of the spectrum, really seemed to win the day. If you sold premium going into that, and a lot of people were very aggressively. If you remember that session the day right before the election, everything that was quoted out in the VIX pit was VIX puts and all sorts of volatility selling type strategies. And everyone seems like they were fading the election pretty aggressively. And then, of course, in the immediate aftermath, that seemed like completely the wrong thing to have done because everything was spiking across the board. But if you maintained your composure, you maintained a little bit of your discipline of your system, and you watch these things unfold with a little bit of a patient mindset, that ended up being the smart play. Whereas if you scrambled in the after hours when the futures were moving willy-nilly, it ended up hurting you. Jim, that probably was an interesting period for you. Obviously, a lot of your strategies focus more on the premium selling side of the fence. So what has this whole period been like for you? The lead up into the election, of course, that very, very tumultuous election day and evening itself, and then this subsequent kind of slow sell-off we've had in vol as a result.
Mark, I only wish I had access to be able to do something to the futures overnight. But, looking at it, I tend to agree with Chris, too, that it was pretty much a non-event for most of the portfolio. In fact, if you just sat there and did nothing, you probably benefited more from, the unexpected rise in some of the categories that had not done as well that maybe you were sitting on being patient with and then benefited from after the election. I think that some of the bigger stocks like Facebook, Google, Amazon, Apple, some of those that are getting hit so hard now, it reflects the fact that most people piled into those before the election as maybe even a safe haven. And now you're seeing the results of the unwinding with that and people trying to get into the categories that are going to benefit from a President-elect Trump at this time. The put credit spread selling that we did, we made some good money on simply because market went up when, we were not so sure that it was going to happen. But there's other methodologies we use that helped, kind of give us an indication afterwards that maybe the market was going to take off a little bit, and it did. So I consider myself as much lucky as maybe skillful at this point, too.
Sometimes it's good to be lucky, if you're, you can be very skillful, but a little bit of luck sprinkled on top never hurt the equation. Same question for you, Mike. Obviously, you're dealing with a lot of retail clientele, managing a lot of their protection options on the downside. You're also writing options and paying for a lot of that protection as well. So kind of like the Swan guys, you have skin on both sides of the game. I'm curious, what has this entire period leading into the election, then that tumultuous election eve or election night, and then, of course, this subsequent period. What has that been like for you? And more importantly, from your clients, have they been ringing you off the hook, or what's that been like?
Yes, no, maybe, and kind of. So I agree a lot to add to what Chris had said. I think it is about timing volatility in a lot of ways. Right here, you have a panel of hedgers on your show today in a lot of ways. A lot of us do things with hedging. And one of the things, just to kind of add to it, back when, just in early November with the VIX above 20 as it was, there was a lot of fear going on. I remember that was when it looked like they were going to reinvestigate Hillary right there on the spot. Those are opportunities with which you could sell some premium. If you were selling puts at that time, obviously that turned out to be a really nice trade with what the market ended up doing. But you really need to have a gauge on volatility as you're doing this. Even if you're not trading the VIX directly per se, you really need to have a gauge on it in terms of how you would trade differently in a higher volatility environment versus a lower volatility environment. To answer your question, going into the election, I was taking a lot of things off the table just out of fear that if it was, everybody felt that Hillary was going to win the election, and if Trump did win the election, then the markets are going to just tank, and everything's going to be horrible, awful, and bad, and that seemed to be the perception. So that seemed to be what the market was telling us in a lot of ways. So with that being said, my philosophy going into the election is that, okay, if Hillary wins, I don't see a ton of upside, but if Trump wins, I do see a lot of potential downside. Now, of course, so in a lot of ways, and I talked about this on the option block, I scaled out a lot going into an election night. And of course, during election night, of course, Trump won. S&P futures are down over 100 points during that night at one point. But what I thought really calmed the storms, and I'm not much of a political person, especially, well, at least not on the Options Insider Network. I tend not to be, but it does pain me to kind of give credit to both parties based on election night. I felt that Trump gave a very good speech at 2 a.m. that night, his acceptance speech. I think there was, myself included, a lot of people in America thought he was going to say something like, "You're fired," or "In your face, Hillary," or who knows. But he didn't. It was very gracious. He wanted to reach out to the other parties. And then by the same token, the following day, Hillary did the same. She was very gracious in defeat. And Barack Obama did a great job too. And I think that those three speeches really contributed to the calming of the craziness that we had that night with the S&P being down over 100 points. Now, with that, whether I believe anything that any of those three people said, that's another story. But I do think that the speeches that they gave really calmed things down. And in terms of post-election, I am shifting over to the financials a little bit, and I'm getting more bullish, not just because bullish on the market in general and shifting over to financials a bit, not just because of the Trump victory, but because of the fact that we are making new highs at this point. We aren't today, obviously, but we have broken through some key barriers, and those key barriers are the 19,000 mark on the Dow, the 2,000 mark on the S&P, and I've been adding more deltas to the portfolio because of those things. I do believe that banks are going to be a good place to be. Now, the argument against banks and the financial sector is that a lot of these regulations that Trump is going to get rid of, supposedly, those won't happen for at least a year, and that's a very good point. But I believe that the brokerages will increase on two things. The first thing is and banks and brokerages, the financial sector. The first one is if we have rising interest rates. If we have rising interest rates, I think those, the banks, because they can have better spreads, the brokerages, because they can actually make some money off margin again, I think that'll be beneficial to them. The second reason I think that sector will do well over the course of the next year is because of the fact that the perception is that Trump is going to make it less of a regulatory environment in the bank and brokerage world. Whether he does it or not in the first year probably isn't going to happen. I would agree with a lot of people on that, but I tend that this is a perception-driven rally, or it will be a perception-driven rally, and it'll be a by the rumor type of rally in the financial sector. I think with volatility the way it is in a lot of areas, I talked on the option block yesterday about a hedge that I had put in place for on the strategy block, and a way with which you can buy at higher levels and have a certain hedge in place. I think that that makes a lot of sense right now if you're looking to get into something like XLF or a JP Morgan or just one of the financial stocks that could benefit based on the things that I'm saying. So there's been a lot that's happened over the course of the last couple of weeks, and can't say this has not been an exciting time.
No, there's quite a bit to unpack over these past few weeks. So if you're trading options, if you're learning about options, if you're trying to implement them for your clients for the first time, it has been a very, very tumultuous period. I think we can easily pull some takeaways from this period for a lot of our listeners out there who have been watching this, maybe scratching their heads and just being, I don't understand any of this. Obviously, one of them we already kind of touched on, which is, of course, that at the end of the day, the patient trader certainly seemed to win out in this environment, particularly on the volatility premium selling side of the fence. If you have kept a cool head, didn't scramble to cover at some of those really extreme moments, then those trades actually fared fairly well. So that's probably definitely one takeaway. One takeaway too that I think is worthwhile, I think a lot of you guys touched on as well, is that effectively using options as your primary tool actually insulated you from a lot of the madness and maelstrom right now in this event, because most of the options and most of the products you trade options on in terms of the audience of this program, so your big indices, your big individual equity names, they don't trade in the after hours. So a lot of that crazy turmoil in the after hours you couldn't really do anything with unless you were diving into the futures. So in that case, maybe that kind of prevented you from diving into the maelstrom when maybe you didn't really need to, and that also could have been a beneficial thing. So a good takeaway there. Sometimes people complain about that a lot, but I think this might have been the one time when that prohibition seemed to work out in a lot of people's favor. And then third, of course, as we're in this new volatility regime where it seems like volatility has been steadily decreasing as we're continually rallying in the broad indices. For all of you guys who are always writing in asking us about how to use options to hedge your portfolio, et cetera, this is obviously a very favorable environment for that. Lower volatility means, of course, you can buy those puts cheaper. Again, we talked about skew on this program in the past. Just watch out for skew as we rally those puts. People start to want them more. So implied volatility as skew is an issue. So make sure you're not overpaying from that perspective. But otherwise, in a broad general sense, this is definitely an interesting time to be looking at putting on some protection. Well, that said, let's go around the horn again with one last, maybe some final thoughts, some final takeaways, at least for this subject in terms of post-election volatility before we get into some of the other topics we have going on the show. Maybe, Randy, we'll start with you. For our listeners out there, the advisors, the asset managers who've been watching this period and kind of maybe just are in awe of the swings in volatility we've seen, what are some interesting takeaways, you think some lessons they should walk away from this from?
Well, I think, first of all, don't overreact to what you think may happen. I go back to 2000, the election when Bush and I think it was Bush and Gore, the recount. That was something that was really crazy. Obviously, that went on for weeks and weeks. I guess if it could have turned out like that in this election where people were actually contesting the outcome, it could have gotten really ugly in the markets. But you know what? To me, it's usually when you have people betting one way or the other, and it seemed like it was 90-10. 90% Hillary was going to win. And when it's usually that one-sided, I think it's usually that's the side that loses. And I said the same thing during the Brexit. So to me, it was just another lesson learned of it's really hard to predict what's going to happen.
Yeah, that was definitely a worst case scenario that I was envisioning as well. Of course, I was on the SIBO at that time, and remember that tumultuous period of the 2000 with is it Bush, is it Gore, and just the volatility that ensued for the better part of the month as a result. And a lot of people were maybe envisioning a similar scenario when Trump was leading early on and recounts and fighting over the election, which is why, of course, one of the reasons the market was selling off so aggressively. And Mike was right. Once those conciliatory speeches started coming out, it seemed like we weren't heading for that. That really seemed to kind of smooth the waters and set us on the path that we're on now, this lower volatility, higher underlying environment. Chris, same thoughts for you? Any of our asset managers or financial advisors out there who are listening who maybe are wondering what the takeaways they should have from an options perspective from this very tumultuous volatility period? Anything you want to share with them? Have at it, sir.
Yeah, I just want to touch on the skew portion. Right before the election, skew got really steep, as you mentioned earlier. It wasn't as steep as the Brexit, but as soon as the results were in, it completely collapsed. Now, since mid-November, we're starting to see a pickup back in skew. So that's something to keep an eye on. I know volatility is in the lower end right now with this rally, but if that skew begins to creep up like it's been over the last few years, should be a concern. When you're pricing credit spreads, put spreads, what have you.
Yeah, that's definitely a good takeaway here. And, the general thought is, volatility is cheap. I want to go buy puts. And that usually is the case. But, of course, that skew can factor in. And when things start getting a little antsy, people start bidding these up. And the skew, as a result, can start to cause issues. So be cognizant of that if you're out there buying protection on a regular basis. Jim, same question for you. Someone who's listening and they want to maybe have some thoughts for takeaways from this period from a volatility and options perspective. What would you say to them?
I agree with Mike. I think strength will beget strength in this particular environment, and the things that have been doing well, like the XLF and the building material, or the materials and the industrials, and even quality stocks like a FedEx, for instance, will continue to do well. I think it'll be interesting to see, what happens if we do get the kind of tax reform they're talking about right after President-elect Trump is elected. I think that could light a fire again under the market, although I think we probably need some sideways consolidation for now just to kind of either capture the gains or test the breakout, so to speak. But a lot of the weekly charts are saying higher, in many of the different categories. And so, one of the things I've been doing on a smaller retail basis is selling the weekly options with the premium that's in there, especially on a stock like FedEx, where you can pick up extra income or return, let's say, while you wait for the next leg of the of that particular stock or your particular ETF to move higher. So, I think we may see some consolidation, but I think we will see higher prices down the road too, especially if we start to see some of this legislation get through that could be, very good for businesses going forward.
using the short options, particularly in the weeklies, as a way to get paid to get into some of those long positions and underlying positions. That's certainly an approach we've talked about here on the show in the past, and one that, in general, certainly works better than just slinging the underlying most of the time. So we definitely have an eye on that. Mike, same question for you. Round it out for us here. This has obviously been a very tumultuous electoral period. Any takeaways you want to have our listeners that should pull from this from an options and volatility perspective? Have at it, sir.
If you're hedged on election night, you don't have to worry whatsoever. I was looking at the elections. I manage millions of dollars like we all do here. And I was looking at it where, well, a lot of non-option people were probably concerned that, oh, no, I'm going to have to listen to clients call me tomorrow because I'm down 10%. That was not even a thought in my head. I was just looking at it with sheer fascination as we were going through it. So hedging is definitely something that has a place in everyone's portfolio, I believe. And I think the main takeaway is that if we would have opened up 100 points down in the S&P, hedgers, like pretty much all of us here from what it sounds like, would have viewed that as a major opportunity to roll a put or put on a ratio or whatever it is that we do. Whereas people that aren't in the option trading world would have viewed that as, well, we got to talk about how buy and hold is important to 90% of our clients who are going to be calling today. That's the main takeaway I got.
I like that. Puts are your friend. That is the takeaway of the election cycle. And since we're talking puts, seems like puts are on everyone's brain these days. So let's get into it in the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market. So we do it for you. It's time to get the buzz.
All right, everybody, welcome to The Buzz. Like the man said, this is the portion of the show where we break down some of the breaking news, trends, topics in the world of options that pertain to the advisors in our audience, because, you guys are always running around. Maybe don't have time to look at all this stuff the way we do. And Mike mentioned puts, and puts certainly are on the brain for a lot of people these days. A lot of different stories and different ways of analyzing this. We'll get to a couple of them here. Starting off with you guys over there at Swan are turning the Swan site into quite the little content portal. You had an interesting article up there. I'll let you guys summarize it for us, but it was interesting. I like the title, Straight Talk on Put Options. Mike was just talking up how kind of puts were your friends in this environment, and if you had them on, you could kind of sleep easily that election night, whereas others who were just straight up, buy and hold the underlying, they had a rough night. There were some Tums being popped, I'm sure, and some very sleepless hours. So Randy and Chris, you guys obviously had this up there on the site, the Straight Talk on Put Options. Walk us through the salient points for our listeners and what they could take away from this article.
The whole thing about is hedging your bets, put options. And one thing I didn't mention about the election and the last show that I was on with you, Mark, we talked about presidential hedges, right? Election hedges. And I think one of the issues was, yes, futures were down 100 handles. They did go lock limit overnight, but people had a problem with the monetization of these hedges. And this is where there's a big difference between putting on short-term hedges versus longer-term hedges. And we at Swan, we believe in always being invested, always being hedged. And our hedge really is a longer-term hedge. So short-term events, like we've mentioned a few already today, we're not going to be susceptible to these short-term events because we're in it for the long haul. We're in it for larger moves in the marketplace. So, like I said, skew got very, very steep right before the election. Results come out, futures go lock limit. I think a lot of people that had short-term hedges were patting themselves on the back, and then all of a sudden the futures aren't opening up as low as they thought, and there's a huge rally the next morning, and people scrambled. You can see in the skew measurements, they scramble to monetize their hedge. So there are some nuances when you're doing shorter term hedges, especially if you're managing a portfolio of underlying equities, et cetera. So it's again, you have to be careful what kind of hedge you're choosing between shorter term and longer term hedges, and basically what you're trying to accomplish here. So I know the whole hedging your bets put options is a form of insurance. There is a deductible that you have to pay for that. And it was just a basic example of owning perhaps the 100 strike put, meaning giving you the ability to sell stock out at 100. If your stock drops from 100 down to 60, well, that put at expiration should have $40 of intrinsic value. And that's really the protection that you're going to get. So in a nutshell, that is a very basic lesson of what puts should do. But again, to summarize it, excellent way of ensuring. You have to be cognizant of volatility, both short-term and long-term. You have to be cognizant of skew and term structure. And this is some of the things that we're constantly working on here at Swan. And, again, within our thesis of always invested, always hedged.
Well, we know from interacting with our audience that they always have questions about puts, so you can never have too many primers on all things puts. If you want to find us for yourselves, listeners, we'll put a link in the show notes. You can also just search for Straight Talk on put options, and that should get you there as well. An interesting overview if you're one of these many people writing into us on a regular basis. How do these put things work? That one could walk you through it. Going to the other side of the put fence, a lot of people have been looking at, in fact, I've talked in a lot of some of our other shows, if there's one narrative I've seen from an options-oriented research angle this year coming out of conferences like Risk Management and a bunch of other events and the big papers I've seen, it seems like everyone has become just collectively obsessed this year with selling puts. It's like everyone has awakened all of a sudden once again to this very old strategy is somehow new again. We've seen studies after studies coming out of SIBO and OIC and others and other unaffiliated groups who are just writing, big investment banks and others who are talking about the risk premium you can gather there versus selling covered calls, things like skew that we were talking about earlier. Well, it seems like this collective narrative maybe is starting to be caught up in the pensions world as well. The Pensions and Investments had an interesting article breaking down how a lot of these put-right funds are starting to get a little bit of traction out there. Pension funds who are traditionally, notoriously, some might say, risk-averse, starting to open their doors, not just to options, which is a good thing, but also to some of these strategies that maybe would have traditionally been prohibitive to them in the past with, of course, all of the option writing, put writing in particular, being seen as a very, very risky thing, even though a lot of these same funds will turn around and write covered calls. That's a conversation for another day, but they're highlighting a number of different large funds which are starting to add them. UBS Asset Management, they're starting to run about $400 million for the Hawaii Employees Fund out there in terms of a put allocation. The South Carolina Retirement System also going to put in about $800 million into put-right strategies. Illinois State Universities also putting off, seems like $800 million is kind of the put allocation there, but still an interesting thing. So it's very interesting for a couple of reasons. A, that these big pension funds, many of whom in the past have had restrictive covenants against using derivatives, are now starting to awaken to some of the benefits of these strategies. And then also that they're starting to put sizable allocations. I know, Randy, you have some interesting thoughts there regarding interest rates, and perhaps this is a play on that. What are your thoughts on that, as well as just in general, these traditionally cautious pension funds opening the doors to something as seemingly scary to them as writing puts?
No, I totally agree. I think it's people are out there searching for yields. You're searching for potential opportunities to make some money. I think it's good, obviously, that people are involved in the options market. We all think on this radio program that this is a good space to be in, and there's definitely some opportunities. On some level, I have to say this may be kind of contrarian is with all the interest, kind of like the whole active versus passive movement that's going on in the market, shift away from active management towards passive. Is this kind of, if you want to be a contrarian play, that's somewhat concerning. That seems like it's getting very crowded at this point. And of course, it is 7+ years into this bull market, and that's obviously when you think people are going to start piling in and really taking advantage of quote free money. But of course, we all know on this show that there's no real free lunch from that perspective, and it's probably a little concerning at some level.
Jim, this must be music to your ears. Obviously, this speaks very directly to the type of strategies you like to employ. What are your thoughts on a lot of these traditionally conservative pension funds opening the doors, not just to options, but to a strategy that's near and dear to your heart, the put writing strategies?
Mark, I think it's great that they're doing it. As you know, put writing is one of my favorite strategies, especially serial put writing on certain stocks. Now that we have weekly options, it's just, it is a way to coin money in particular situations with the right stocks and with the right amount of premium that you can collect in a situation like this. I think it may also reflect, let's say traditional financial advisors in general, but I think pension funds are beginning to realize that, it's not such a risky thing, and it is a way to enhance return in the funds beyond the traditional methods. And it's really, a lower volatility type of strategy too, to help them increase their returns, or at least, generate more income for the fund itself. So I think it's an awakening, and I think I think people are going to realize that if they do it more, they're going to like it more, and I think we'll see more of that in the future.
Mike, I know you're not a straight-up put writer all the time, but you are writing a lot of options to pay for those puts that you're buying all the time on behalf of your clients, including buying and selling other legs for put spreads, selling calls against it. What are your thoughts on a lot of these pension funds, like we said, kind of opening the doors to more of these option writing, particularly in this case, put writing strategies?
I think it's about time. I think that if the put writing mentality would have been, not saying that that's what you need to do to replace your equity section of your portfolio, but I think in a lot of instances over the course of the last 10 or 15 years, a lot of these funds have been struggling. And I think had they done something in the option world, I think it would have helped them a lot. So I think that they're coming to the party late, unfortunately, for the people that are benefiting from those funds. But I'm happy it's happening. Because I think overall it's going to be a good thing. Now, does that mean this is the perfect environment to come into it in? No, but I think they've finally decided to buy the tool in the hardware store that they thought only the weird guy on the corner would use for weird situations. They finally decided to buy that tool, and I'm happy they did.
Yeah, you're right. The timing is a little bit suspect. They could have maybe picked a better period, but we all know these large funds take a long time to get on board with a new strategy. They need to see a lot of back testing, a lot of evidence and everything else, and they have to open up their doors to this way of thinking. So it's a good thing, I agree with you guys in general, that these funds are starting to be more receptive to these ideas, where we all know a few years ago, certainly pre-2008, if you called up a large pension fund and said, hey, maybe you should, I don't care, use options in any capacity, buying puts, selling puts, usually that phone would be hung up in your face pretty quickly. Now that's story is changing to the point where a lot of big funds are now actually writing puts, which shows a little bit of a mentality shift, which is kind of interesting. And of course, Eric and our friends over at OCC, they're always gallivanting hither and yon, couldn't be with us today, but that doesn't mean it wasn't a banner month for them this past month, and in fact, a banner month for options overall. So if you're wondering yourself, hey, how are these options things, how are they doing in this crazy environment? Well, a lot of tumult, a lot of volatility typically is a good thing for options, and we saw that again this past month. The OCC just putting out their numbers for November. It was the best ever November on record in terms of options volume, with overall November volume up about 20% from November this time last year, so about 393 million contracts. Again, the highest November options on record. Overall exchange listed options volume is again up about 19-20% from last year. Equity options volume also up substantially, about 16% from November of last year. If we parse it even further, ETF options volume up 55% from November of last year. Again, that shows you where a lot of the activity was focused over this past month, a lot of it in the ETFs, and also in the indexes. Index options volume in November up about 47% over the year before as well. So a lot of that activity focused in the broad ETFs and broad indexes. And again, it's not surprising when the indexes were rocking and rolling the way they were. Even with that big month, though, it's still been a somewhat quiet year overall for options volume. Year to date, ADV is down about 2% compared to this point in 2015. So we'll see. November was a rocking month. If we can put in a pretty aggressive December, and we'll see if we stay on path the way we are now. We'll see if the Fed can maybe inject some volatility into that. But it seems like we might be on path overall for a slight decrease this year, even with a rollicking month like November. Chris, I'm sure probably these numbers don't come as a surprise to you, given just how much tumult we saw in the options market throughout the course of November.
No, not at all. Again, I mean, people were prepared for the event. Whether it panned out for them or not, it's a different story. Kind of another point as far as the pension funds are concerned, the 3 E's of trading are education, exploration, and execution. And, we at Swan, we've been thought leaders, and we do a tremendous amount of, we spend time and effort educating people, just as the SIBO has done and the OIC has done over the last few years. So, they've gone through their education stage, they've been exploring, and I think it's great that organizations like that are now executing this plan. So, as far as the volume is concerned, no, there was no surprise about it. I think volume is going to continue to grow, and as more and more pension funds and more investment advisors turn to the options world, I think there's plenty of space to grow. I mean, I know here at Swan, we've been doing this for 19 years, and we've grown with the market, and the market's going to continue to grow with us.
Yeah, it has been an interesting time, and you guys have been doing your advisor education events, and the OCC and OIC obviously out there all the time doing education. So there's a lot of education to be done. Speaking of education, maybe we'll do some on this show as well and open up our office hours segment.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to the office hours. This is indeed, as the man said, the portion of the show where you guys get to take the reins with your questions and comments. Really quick at the top here, we ask you guys questions every week about what you're thinking about different aspects of the options market. Our question this week, something interesting, we don't touch on that often on this program. I thought it'd be good to bring it up here. We asked you, commodities are capturing a lot of attention and generating a lot of volatility. What is your option of choice when trading these commodities? We gave you 4 choices in this. We said GLD or the Comex Gold options. We said USO or WTI. We said TLTs on Eurodollars and 10 years, so kind of a fixed income complex there. Or for some of our more FX-prone listeners, we said Euro USD or Pound USD. Mike, I already know your answer for this one. But Jim, you haven't had a chance to weigh in on this. So what are your thoughts? Which of those 4 do you think is A, winning the poll? And then B, what is your favorite of those? What is your favorite? If you're going to trade some commodity volatility, which of these products would you choose? Or maybe something different?
I would bet that gold is winning the poll, the GLD, but I would tend to favor the TLT simply because I think that we've had an overreaction in the spike in interest rates, with the 10-year getting close to 2.5 right now, just under that, I think. And it appears that at least there may be a short-term trading opportunity in the TLT to the long side, at least in the near future, once things kind of settle down and we continue to see perhaps sideways to down movement in the market. I expect the TLT to start improving, or at least offer an opportunity for some upside.
So a vote for gold winning and a personal vote for TLT. Randy, same question for you. Which of these do you think is winning our poll, and what is your personal choice amongst these options?
Well, I think I'd probably agree with the previous speaker. We don't really do a lot of commodities. We do SMA on gold, on GLD, and TLT. So we like both those products, and we like the options on those products. Otherwise, I think that would be our argument at that point.
Interesting. Prescient choices. I won't color your response, Chris, by giving you the answers just yet. But same question for you, Chris. What is your choice, and what do you think is winning?
Well, I'm going to approach this from a volatility perspective, and with the downdraft in TLT lately, I mean, volatility has spiked quite a bit. We're seeing over 90 percentiles if you're looking at 1 year, 3 month at the money implied. So I think if you're a premium seller, there's some opportunity in TLT. Gold is always very interesting because you've got a different type of skew there. You always have that smirk. So it's nice to sell strangles on a product like gold, where you're going to get a high skew on the put and a high skew on the call, versus supply side products. Sometimes it can be challenging, like, an S&P 500 or any other equity. So, you know what? I'm going to touch on USO also for you oil traders out there, because USO is if I'm going to be a premium seller, I want a stock that's going to be in a range and just ping pong back and forth and keep those volatility levels elevated. So, oil volatility levels does, flow up and down, but better yet, I think that's been a very good range bound product the last few months, where, USO gets up to $12. That's been a good leaning in point to sell upside calls. If it goes back down to in the $9 or low $10, that's also been a good area to lean in and sell downside puts in that product. So, I don't do currencies, but I can definitely make a case for gold, USO, and TLT.
Yeah, it's an interesting mix. And Mike, I know you were voting on USO and WTI earlier this week, even though I know in your heart of hearts you're a gold guy. And it seems like all you guys who pick gold, you're in line with our listeners. 41% choosing the GLD/Comex Gold as their option of choice on the commodity space. I thought maybe all the action this week with OPEC would kind of tilt that in the favor of USO WTI, but not so much. That's only a second place. It's a close second, 37%, but still trailing gold, which I thought was interesting. And then the currency is coming in at 12%, and TLT Eurodollar picking up the rear with only 10%. So no love for the rates complex here these days. Everyone's too fixated with gold and US. So I like your point about the skew in gold, Chris. That is a good one, because you're right. In terms of a product that has exhibited the most variance and interesting types of skew over the course of the year, it kind of hard to do better than gold. It's been all over the place, and it's been very fun to watch. And for a lot of our listeners who are maybe used to one type of skew, looking at gold is a very educational process. All right, moving on. I got a question here. We were talking, it seems like we got puts on the brain this show. So does Jay Allen here. He writes in, says, I have a question for the advisor's option. Well, he sent it to the right show. He goes on to say, what do you typically recommend for hedging portfolio risk, SPY puts or SPX puts? Can you please explain some of the differences and why one product is superior to the other? Thanks for the show and the app. Well, an app user. Well, welcome to the show there, Jay. Glad you like the show and the app. This is something we've touched on before in the past, but it's probably worth, given just the number of questions we get on this topic, it's worth repeating every 6 months or so here on the show. But I know, Randy, you guys over there at Swan, you typically utilize a lot of the big SPX stuff because you're doing, obviously, a lot of big portfolio hedging there. But for a lot of our listeners out there, maybe who are managing smaller client size, or they want to just trade a little bit more smaller, nuanced positions, maybe outline why you guys like SPX, and then also maybe some of the benefits of that versus SPY, or vice versa. If you feel like arguing for SPY, you can have at it there as well.
Sure, absolutely. Well, this is kind of a multi-pronged answer. We use both SPY and SPX options in our strategies. It's mostly delineated along account size. So the smaller account size, because it's 1/10 of the SPX, for smaller accounts, SPY is really the best choice. In terms of commissions, most likely it's going to cost you more money to trade similar SPY is going to typically cost you a little more in commissions. The other benefit, I think, of the SPX is you get better tax treatment because it's a broad-based index. You get the Section 1256 contract treatment, which means 60% long-term, 40% short-term. So everything else being equal, we would go with SPX, assuming the account size is large enough to be able to handle selling, contracts, because obviously you can't sell partial contracts.
So actually, I think Randy kind of covered that, so I think maybe we'll squeeze in another one or so if we can here before we have to wrap up, because we're kind of coming up against it. This one comes from JT Monroe. Another kind of question we get different themes on a lot. He says, I overwrite calls for a handful of clients, mostly in SPY. So he's chosen SPY. I've tried to grow my options book of business, but it seems like I'm mostly lumped into the alts segment. I refer to it as the alts ghetto because the allocations are so paltry. How do I get clients to start viewing basic overwrites as part of their traditional equity allocation, rather than a paltry 2% alts allocation? Mike, this is something you bump up against all the time, because you're always trying to talk clients over to the quote-unquote dark side of using options, even when it's just buying premium. What do you have to say for advice to our friend here, Mr. Monroe, who's doing SPY overwrites and wants to kind of grow his allocation?
Well, I think that what I struggle. I have clients that I refer to either as options insiders or options outsiders, and I would say 97% of them are.
Are you stealing our
insiders.
branding here, sir? Do my lawyers need to be involved in this?
Oh, crap. I wasn't supposed to say that in public.
You said that on the wrong show.
I did. No. But what I do with them, and one of the reasons that they're options insiders is because a lot of them come from being on the Options Insider Network as frequently as I am. So that's kind of one of the reasons that it is. It's also kind of play on words in that most of the people that I work with have some type of background with options, and that's what attracts them to me. For the people that don't, I think that it's like anything. Unfortunately, it's not like jumping in a swimming pool. When you jump in a swimming pool, you jump right in. It's painful for 1 second, and then your body gets used to it, and it's better. The people that dip their toe in the water are spending a half hour getting used to the water before they really enjoy swimming. So with covered calls or with options, unfortunately, I think you just need to continue to dip the toe in the water and gradually add more and more to the allocation, assuming it's appropriate for the client with whom you're working with. But I think just education and dipping the toe in the water. The covered call is a great place to start because I think it's pretty easy to explain. But I think that maybe set a realistic goal if you're looking to expand the 2%. Maybe look to go from really focus on getting from 2% to 3% and just any other first, and then just any other goal that you're trying to do. But I really think I don't see any other way to do it besides just dipping your toe in the water.
Jim, same question for you. You're obviously out there not doing the call overrights, but selling the puts, but we all know same difference here on the program. What do you have to say to our listener here who's looking to grow his book of business on the SPY overright side?
I don't know that I have much more that I can add. I think it is kind of dip your toe in the water. But, one of the other things that I did as an advisor, it took me a number of years to start thinking about spreads beyond just the traditional, covered call right. And I'm finding that I can use combinations of weekly options in spreads to offer clients, potentially risk-free trades is what I say, but high probability types of things to get your feet wet where you have little risk of loss and a good potential for a nice return on the portfolio. So beyond what Mike had to say, I would just simply say maybe explore your horizons to, things where you might be able to improve your profitability and therefore entice people a little. Well, I shouldn't say entice, but at least interest people in exploring other strategies that may help improve portfolio return and therefore, demand a larger allocation from the alt being 2% at this point in time.
I think you can go with entice. I'll allow it. That's a good word. There's nothing untoward about enticing people. I always say going to the dark side, so it all works. To each their own. Chris, I'll give you the final word on this. This is obviously something that you guys at Swan deal with on a daily basis. Bumping up against, obviously, as his articles we just outlined show, the pensions funds are warming up, but still, it's always a fight to get more allocation. What do you have to say here to our friend, Mr. Monroe, who's trying to build a book of business doing SPY overrights?
Yeah, there's no question that selling premium via calls or puts or some combination does add incremental value to portfolios. And we've been doing this for many, many years here at Swan. So I think more and more people, like you just mentioned, the pension funds are getting more comfortable with this as they are educated and they go through their exploration and their own due diligence process. But I think, the allocation of this type of strategy has to be much greater than 2%. And, almost, I think we're going to see this allocation grow and grow and grow as the market grows and people accept, premium selling and option writing more and more. So, there's a lot of tremendous good work out there that we produce, a lot of good work that the SIBO and the OIC's produced, and a lot of other venues. So I just think people are starting to get wind of this and learning that, hey, wait a minute, I can produce a better product here via premium selling.
All right. Unfortunately, that's all the time we have for the office hours. It's also all the time we have for this episode of the Advisor's Option. What a journey it has been. We started off in the realm of all things elections and volatility, pre and post, and even during. I then got into all the breaking stories in the realm of puts. Everyone's got puts on the brain. Then we took some of your questions, a lot of them revolving around puts, including a few call overrights and a few other things in there. A very, very fun show. Let's wrap it up in reverse proximity order this time. So let's start off with Mr. Mike Tusaw out there in St. Charles. Just a hop, skip, and a jump from the Options Insider Studios here in downtown Chicago. What is cooking in the land of RCM Wealth Advisors, sir?
Well, it's not often that I'm one of the closer ones on our show. Usually I'm the one that's one of the further ones. But anyway, I do. If you are interested in any of these strategies, you're an advisor and you're looking to learn a little bit more about them, I did write a book on my longer term option strategies. It's available on Kindle for Amazon. It's called Go Long, New Option Strategies for Buy and Hold Investors. And you can get it for less than the price of a Starbucks, depending on which kind of Starbucks you buy. Yeah,
if you buy the fancy ones, definitely, you got them. If you buy like a little drip, maybe it's equal. We'll see. But check it out. Look for Mike Tusaw. Tosaw is how you spell his last name if you're going on Amazon and want to check that out. The book, of course, called Go Long. And Jim, same question for you. what is cooking? What is coming down the pike over there for you as well as the team over there at MoneyBlock?
Well, the MoneyBlock continues to improve its platform and has a whole new set of new tools that people may be interested in. I encourage people to go to www.moneyblock.com. I guess I don't need the 3 W's in front, but moneyblock.com, check it out. You can do so for free. In my particular case, like I said, my thing right now is these risk-free projection strategies. I'm trying to find ways that I can eliminate the risk and make money each time I put together a combination of option strategies. Anybody who may be interested, feel free to email me at jkeeling, JKEALING at moneyblock.com. Be happy to tell you more about it if you're interested. And I appreciate being on the show. Thanks for having me. Maybe one of these days I'll make it back, too. Thank you.
Hopefully next time you'll be beaming in from a sunny and warm Southern California. And, of course, can't forget our friends over there at OIC. Check them out, optionseducation.org. If you scroll on over to the right-hand side of the homepage, you'll see that Options for Advisors tab. Click on that. That's where you'll find all the latest advisor resources that they have there. You'll have to register for some of it, but it's worth doing. All the strategies, all this data I'm always talking about on the show, a lot of it comes from our friends over there at OCC. So check it out if you want to arm yourselves with a lot of great data when you're sitting down to talk with your clients. And last but not least, you guys over there at Swan have been quite busy. You've been going hither and yon, doing, I believe, your 10th box events, educating a lot of advisors about all of these things we're talking about here on the show, about how these options things actually work in the real world. So give us the latest on those, as well as whatever else is coming down the pike over there in the land of Swan Global Investments.
Sure. Well, I think as a firm, we've agreed to continue the 10th boxes into the next year. I think we've already got our schedule actually all set up for next year. So most likely we'll be coming to a city near you. I think we've got 22 of them planned for 2017. I think another thing that I would go to our website and get our most recent version of the Good, Bad, the Ugly. That's our quarterly newsletter. We've kind of taken our strategic vision of taking our strategy and applied to different assets out there. And so we've gotten into the concepts of optimization between assets and rebalancing and rehedging. I think it's a pretty good, interesting read, and I think there's going to be more about that coming out over the next quarter.
Yeah, you guys have really been turning the SwanGlobalInvestments.com into quite the content portal. So if you're looking for a lot of advisors and options-oriented content, in addition to our friends over at OCC, check out Swan Global Investments. If you're specifically interested in those events, go to 10thbox.com. That is the number 10, then THbox.com, and that will tell you where the next one is coming, and hopefully it'll be in your area, and you could register and go check it out. And on behalf of Randy and Chris, as well as behalf of Mike and Jim, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and of course, for sending in so many and varied questions. Keep them coming, and we'll see you next time on The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.